My name is Mike Walters. I'm a firm coordinator in the broker-dealer program. Been with the PCAOB about 15 years. Most of that time I've spent in the BD program. I probably met some of you along the way, performing broker-dealer inspections, and I always enjoy these opportunities. Steve and I welcome your questions. We do. If you want to throw up a hand or put it in the chat, we're happy to offer our perspective. You won't be surprised to hear that whatever views we might express are our own and do not necessarily reflect the views of the board or board members or other members of the staff. So our standard disclaimer there. But we do have a lot of experience conducting inspections of firms that audit broker-dealers and reviewing those audits. So happy to be here today. Our objectives are pretty straightforward. Want to highlight a few publications that are critical to the work that we do in this space that may be helpful for you, some of which we pull content from for purposes of our remarks today. We're going to highlight some of our recent observations now that we have fresh inspection results out, and talk a little bit about how the standards relate to some of those more commonly occurring deficiencies, and we'll use some examples to illustrate some of those concepts. And then I'll speak a little bit about some insights that perhaps think of them as root causes or reasons why we as a program believe we might be seeing the somewhat elevated levels of deficiencies that we've experienced in the last few years. And then we'll conclude with a brief update on 2024. So here, get your devices ready. I'll give you a second to get caught up there. But first code word for this session will be 951. Okay, 951. So I mentioned publications. There's 4 here to briefly highlight. Our program issues an annual report each year. Most time it's in August. This year we were able to publish it in July. It tells you what we found in the most recently completed inspection cycle. Again, the July 2024 report talks about our 2023 inspections, some of which the results of which we'll talk about today. There's a second document that's a companion document to that. We call it the supplemental information document. And it takes a wider lens. It looks more over time, generally 3 years, but in certain cases a longer period of time, to talk about what the trends are in the findings, and it slices and dices the data around various characteristics. So a characteristic of a firm might be, hey, I'm a firm that I audit 120 broker-dealers, or I'm a firm that only audits a very small number of broker-dealers. Or an example of a characteristic of a broker-dealer whose audit we might review could be, it's a compliance report filer, or it's an exemption report filer. So there are a number of characteristics, and we take our results and present it in different ways to see what the trends might tell us. Is there an emerging problem in a certain category of firms, in a certain type of audit, that sort of thing. So I think it's a helpful companion to the report. For the first time this year, we published a spotlight. You've heard spotlight a lot today. PCAOB has become prolific in publishing spotlights. The first one specific to the broker-dealer program was published back in January. When I mentioned insights earlier, I'm going to draw some content from that document, as well as some of my own personal thoughts around what's driving the results that we've been seeing in recent years. So all those are fairly recent. The one at the bottom, the staff guidance document, if you didn't read it carefully, you might say, oh, that was June of 2024. No, that's June of 2014. It is, in fact, 10 publication that's been out there 10 years, around the time of the formation of the interim inspection program. But I always like to reference it because it is a very useful document to help any auditor of a broker-dealer think about, better understand how PCAOB standards are scalable and can apply to audits of broker-dealers of various sizes, complexities, and natures. And it talks specifically about the attestation standards, which were brand new at that time. So you can find it on our website. It's a rather lengthy document. It is a technical document, but it's an excellent reference tool. I find myself going back to it oftentimes on inspection. So that one stays out there on the shelf. With that, I'm going to hand it to Steve, let him introduce himself and take us through recent inspection results.
Oh, thanks. I'm Steve Attard. I'm a location leader. I primarily work in the broker-dealer space along with Mike. I do have some prepared remarks. There's the first slide up there that I'll go through in a moment. But before I get to that, I would like to get to the question that Mark from FINRA was beginning to address. It really, as he mentioned, it really does fall more into a question for Mike and I. So here's the question. When 12B1 fees are direct and determined from a mutual fund, the collection and acceptance by the broker-dealer addresses the VA assertion, correct? So let me get to a couple quick things. First, let me give a little background for folks that aren't BD specific, what a 12B1 fee is, because it's actually something, if you're in the BD space, you're pretty familiar with. If not, if you actually own any type of mutual funds, you've paid this fee. What it is within mutual funds, mutual funds allow for a fee or an expense for the distribution of the shares of their funds. The reference 12B1 is actually a reference to the SEC rule, I think it's the Exchange Act of 1940, that allows for this type of fee. And what this fee is, it's pretty straightforward. It's a set rate or a fraction of a percentage times a net asset number. So basically the value of a customer's share or shares of that mutual fund. So it's rate times the quantity. It's pretty simple, straightforward calculation. And that's the expense of the fund. And as a shareholder of a mutual fund, that's something that you've probably bared or paid in the past. Now, with respect to a broker-dealer, where this question's coming from, it's a little bit different because there's an additional step. The broker-dealers receive revenue for selling these shares of mutual funds. And part of that commission or that revenue stream that they're receiving stems from these relationships that the broker-dealers have with the mutual funds. And what's happening here is a situation where a broker-dealer or a registered representative sells a customer a share of an underlying mutual fund, and in return, the mutual fund is going to pay them that 12B1 fee. Again, the fee is based on a contractual rate, the rate that's in the prospectus, times an underlying asset amount. So the question that's coming up here is, with respect to the revenue that's being recognized by a broker-dealer, what assertions would be addressed or can be addressed through the acceptance? And I probably need a little clarity in terms of what acceptance means, but I'll take a stab at what I think it means. So let me start off with kind of the basic assertions, just as maybe a starting point. So the PCAOB assertions, and all the firms I know have maybe slightly different interpretations of these, but it's essentially we have a completeness assertion, existence or occurrence, valuation or allocation, which is what's being highlighted here, rights, obligations, and presentation and disclosure. Did I get them?
You got them all?
Thank you, Mike.
You got them.
So those are the general assertions. This question is asking if the broker-dealer just receives a payment from a mutual fund, does that payment address the valuation and allocation assertion? So when I think about it, and again, as an inspector, when I think about a payment, does a payment really get you to valuation or allocation? So remember, the valuation in this case was a rate times an underlying amount. So if you receive a payment, does that payment really address the risk associated with valuation? I think the message that Mark from FINRA was getting across was probably not, and I think his views are very similar to what my views are. That payment probably does not specifically address that valuation or allocation. Maybe it gets you a little bit to existence. If you receive a cash payment in there, I think that's pretty good evidence that there was some sort of revenue that existed. Is it accurate? Is it valued appropriately? You're probably not getting that level of assurance that you may need from that payment. So maybe I'll pause there, see.
Yeah, you got a question?
Yeah, the reason I brought it up was, typically with the verbiage we deal with, they receive a third-party statement from the mutual fund company. Sometimes those statements are absolutely terrible, if I'm being honest, and it doesn't identify necessarily the exact share class or anything of that nature that makes the recomputation more of a guessing game versus a true procedure. And so kind of the stance we had taken was, being that the amount is wholly independent of the broker-dealer and involvement in their computation of any determination, for say of the third-party statement, agreeing it to cash, almost closes the loop on that standpoint. Now, we have been successful in recomputing those fees for other ones, but again, it all gets back to what reporting is available and how, what the quality of it is. And we fought that with clients and they said, this is all we have. Good luck. So that's why we kind of had to tailor that approach for that, because again, we looked at those prospectuses. It's not always abundantly clear. We could back into the percentage, see if it is relevant on the prospectus for the different share classes. But again, we're trying to just do it right, but at the same time, look the information clear.
Yeah, it's a fair point. And as an inspector, I've heard that that feedback or that thought process in the past. So it's not what you're communicating isn't the first time I think that I'm hearing it. Admittedly, it does get complex, does get challenging. I think the key point that you're getting there is actually one of the points I wanted to drive in a little bit later, which is I thought this was a very good question and a good example that kind of reinforces maybe some of the concepts I was going to bring up in a few minutes. What you're getting at to is testing the completeness and accuracy or relevance, reliability of the information that you're using in your procedure to respond to a particular risk. And that's an important concept, is how do you get comfortable with those statements? What procedures did you perform to get behind those numbers? In this case, the average net assets, or the quantity that rate's being applied to. And admittedly, sometimes it does get a little difficult because in this situation, you kind of have to unwind a little bit. Okay, what's the customer base? How many customers they have? What's the underlying assets of each of these underlying funds? Maybe even more detailed, underlying share classes. So it does get a bit more, and you really need to tailor your procedures to respond to the ultimate risk that's been assessed to that particular account or balance. So again, like I said, I thought that was a very good question, and where I really wanted to use that was as sort of an introduction to a couple of concepts I'm going to bring up, or maybe a couple of the potential reasons for some of the results that I'm going to show. On the first slide we have here is our historical inspection results for the last 3 years. And I think it's safe to say that the results for 2023 were probably, from my perspective, surprising to see a deficiency rate at 70%. I think it's something that is concerning. However, that number needs a little bit of, we need to analyze that number a little bit, and I'll share some thoughts on that, because maybe that 70% isn't quite as representative of the overall inspection results. There are two primary drivers that fed into that 70% deficiency rate for the current year. And the first one was that we have, for 2023, we increased the number of firms that we inspected for the first time from 9 in 2022 to 18 in 2023. And the reason why that's important is our historical deficiency rate in that category of inspection or firm where we're going through for the first time is very high. In fact, the deficiency rate at that category of firm typically runs in the high 80s to 90% range. So we essentially doubled the amount of new firms we're looking at in a population that we know has a historically high rate. So that's certainly one critical factor or maybe driver behind that 70% number. The second driver behind that number is it is maybe a little concerning, because what we identified in 2023 was that the deficiency rate at the largest firms we look at, and now these are defined as firms that audit at least 100 broker-dealers and 100 issuers. So when you kind of think about that a little bit, you're getting into a pretty narrow subset of the firms out there. And what we found in that subset for last year, and I hope this is just a one-year anomaly, but what we found last year was that the deficiency rate for 2023 actually almost doubled. In 2022, the rate was just over 30% for inspections of audits at the category firm. And then in 2023, it jumped up to just under 60%. So when you look at those two drivers or factors and think about how that could influence that 70% deficiency rate, that probably has a pretty big impact on why there was that uptick for the for 2023. Again, it's a number, it's a statistic. I think what's probably more important for us today is to kind of break down a little bit of the areas, or maybe understand a little bit of the areas where we're finding deficiencies. And that I'll jump ahead here. In order to move things along, I'll highlight two categories. First, for 2023, we looked at 100, I think the population was 103.
That's right.
103, we looked at 103 audits of brokers and dealers. So look at the first line on there, revenue. On 87 of the broker dealers we audited, we looked at revenue. So I guess the message I'll say here is, if we do inspect, if a broker dealer that you audit gets selected for inspection, there's a pretty good chance that we'll be looking at revenue. And what we found for 2023 was there's a pretty high rate of deficiencies. 42 is the number. I'll say that is a pretty big population, so there's a lot of different deficiencies, but when I think about those deficiencies, there's three big ones that probably make up the overwhelming majority of that 42 number. The first one is testing inputs. We've found deficiencies with the way and the extent of procedures engagement teams or firms perform over inputs. What are inputs? That's kind of what I was just referring to before on the 12B1 fees. Your inputs in that case would be the rate on the 12B1 fee. If you're doing a recomputation, the other input will be the assets under management. So I'll emphasize with revenue accounts, taking a look and being sure you could corroborate any kind of input into a calculation, that would be of high importance. The second piece actually gets to, I think, one of the questions Nathan was getting at was the use of information and how do you test information used in your procedure. A lot of times broker dealers and auditors rely on service organization reports and reports that are being generated by these service organizations. another area where we're seeing a lot of deficiencies and where teams just aren't performing the appropriate procedures to either rely on that report or that information or test that information directly. The third biggest one is actually a topic that I didn't realize it at the time, but FINRA was kind of highlighting again, revenue recognition and disclosures. Seemingly, it's, again, not the most complex area, just taking a look at the requirements, the disclosure requirements of ASC 606, that's usually the standard where we're seeing it, and carrying those across to what's being reported in the broker-dealer's financial statements. And we're just not seeing the appropriate valuation and testing over those disclosures. The next one, just under that, evaluating audit results, like I mentioned, we looked at 103 broker-dealer inspections. The number of times that came up in our population was 103 times. Identified 18 deficiencies on that. This one's a little bit more concerning because evaluating audit results is really what is a code, or maybe our term for potential gap departures or deficiency that weren't identified by an engagement team. The two standards that were probably the most cited within this group and category from a gap perspective were ASC 606 and ASC 230. So ASC 606 is an example of a departure that would fall in that category would be where a broker-dealer's revenue recognition disclosures did not comply with the requirements of ASC 606. From a 230 perspective, the big thing we see there is where an engagement team or a firm did not identify that the classification of cash flows was inappropriately listed as maybe investing when it should have been operating, or potentially financing when it should have been categorized somewhere else. So these aren't the most complex areas, but we really are seeing a number of deficiencies related to that. So maybe just as you're going through those cash flow statements, really give some consideration to the classification of those cash flows. The others on here are primarily one-offs. In fact, why don't we maybe just move on, which takes us to our first code, or maybe our second code for this session, and that's 267. So, as part of our presentation, we have 4 brief examples. They're higher level, and then after each example, there's a short polling question. So once I go through this example or scenario, just have your devices and we'll go through the polling question. So here's the first one: revenue, presentation, and disclosures. First fact is that the broker-dealer reported revenue of $6 million on its income statement. Okay, so it sounds like broker-dealers on its income statement has one item for $6 million. The engagement team looks at the trial balance, realizes that the trial balance has 3 categories of revenue. One, I guess the first one is $2 million of commissions from mutual funds, then another $2 million for 12B1 fees, and lastly $2 million of revenue from acquisition fees. So trial balance breaks it down to 3 different categories. Then the notes, the broker-dealer included a disclosure that said that was limited to commissions. Commissions revenue primarily includes commissions from the initial sale of mutual fund products and are recognized at a point in time on the trade date. So a couple of key things: 1 line item on the income statement, 3 items on the trial balance, 1 short disclosure on the in the footnotes. Let me move ahead to the actual polling question now. question. Which of the following is true regarding the application of AS 2301 and ASC 606? A, the auditor does not need to evaluate whether there are distinct performance obligations related to the 3 revenue streams, since they are all reported as commissions. Please don't select A. I'll give you a heads up on that one. All right. So B, the auditor should evaluate whether the payment terms for revenue complied with industry standards. Huh. That's actually an interesting response. C, the auditor should evaluate whether the 3 revenue streams should be disaggregated into categories in the broker-dealer's financial statements. And then D, the broker-dealer's disclosures appear to satisfy ASC 606 requirements. Okay.
Might have to open that. Let's see. Oh, people were
That is fantastic.
the first perfect score.
Mike, I want you to take some notes on that. That my
Did you
delivery
get-
must have been spot on.
Did you get perfect score on all your case studies? Okay, we'll see. This is only one. It's a good start, though.
Yeah, thanks, Mike. I did not get a perfect score on those other case studies, by the way.
Me neither.
Yeah, ALL might have, I might need a remedial course in that. Journal entry testing. Here's another brief example or scenario. All right, so the auditor identified management override of controls to be a fraud risk. That's a fraud risk we certainly see with some frequency, and it's usually pretty well supported on why. Next point. As part of obtaining an understanding of the broker-dealer's financial reporting process and controls over journal entries and other adjustments, the auditor learned that journal entries are not required to have descriptions. Okay, interesting. The auditor identified fraud risk factors in the journal entry population, including incomplete journal entry descriptions.
Emphasis on including. That's a hint.
Including. Is that
Factors,
emphasized?
factors is plural, too. Make note of that. I'll try and get you a perfect score.
The auditor performed procedures to test the completeness. Am I emphasizing these words appropriately, or should I?
Oh, you're good.
Okay,
You
I'm
just
good.
missed including. That's only one.
Oh.
Otherwise, you're good.
Let me start over that one again. The auditor performed procedures to test the completeness of the population of journal entries and observed journal entries with and without descriptions. And here's our polling question. All right, so which of the following is true? Because journal entries are not required to have descriptions, the auditor would not be able to evaluate whether the journal entries were accurate. The auditor should only select journal entries without descriptions to test. Nah, don't bite on that one.
Wow. If you give them
Yeah,
the
yes.
answer, then.
I'm just providing some context.
Oh, context. Okay, got it.
It-
Context.
It's after 3 o'clock,
You're right.
right?
That's fair.
Do you want to emphasize this one, C, or should I take a stab at it? I'm okay?
Knock yourself out.
All right. The auditor should inquire of individuals involved in the broker-dealer's financial reporting process regarding requests to received to exclude descriptions from journal entries or to include inaccurate descriptions.
I would have emphasized exclude descriptions from journal entries or to include inaccurate descriptions, but that's just me.
Yeah.
D, no.
Is there a large population of journal entries without description, the auditor can select a sample of those entries to avoid testing the entire population.
All right. You feeling confident?
100% was pretty high on the first one.
It's going to be hard to beat that. It's going to be real hard.
Oh, some of you guys are messing with me. I have a feeling who it is.
3 people.
Yeah.
Yeah. It's a solid B plus, though.
Yeah.
Very solid. Yeah. Okay.
Thanks, Mike. Don't worry.
Message received.
Yeah.
We have a question.
Yeah.
On your last table, the journal entries went significantly down in '23. There was a footnote there. Any explanation to this question in that?
Let me check my footnote.
Yeah.
Yeah. It's a good.
Footnote 10?
That's a good. That footnote references, which is not presented in the table. To your point, so your glasses work well. Those deficiencies were separated as a new category of deficiency this year. So we're good, non-comparable. Good, good financial statement disclosure to highlight the lack of comparability there. So. Because there was a bit of an uptick, so we wanted to single it out honestly for this reason. Yep. Okay.
So here's just a brief table on the results from our review engagements. This would be under the procedures under AT number 2. I found it, again, interesting that FINRA was bringing up this concept of reporting issues that they'd identified, because it's also an area that we identify a fairly significant number of deficiencies. We use a slightly different term in this category. Usually the term you may hear is that engagement teams did not evaluate contradictory evidence. And what we're getting at that is it's almost the same concept that Mark was bringing up, where in an example where a broker-dealer claims a K1 exemption, which, as you mentioned, is very limited to broker-dealers that sell mutual funds and distribute vari annuity products. So broker-dealer makes that claims that exemption. However, the income statement also reports income from M&A activities. So that's an activity that's not the sale of mutual funds, it's not the distribution of variable annuity products. So the way we would characterize that type of issue from our perspective would be if an engagement team failed to evaluate contradictory evidence, meaning that there was revenue that may have been outside of what's allowed for under the K1 exemption. So therefore, the engagement team did not perform enough procedures to support its report on its review report. So that's by far the biggest deficiency I think we come across. The actual testing from an AT2 perspective is usually pretty good. The way AT2 is laid out, if you almost kind of put it on the side and make it into a checklist and you follow AT2 across the board, you can generally get the procedures right, the execution of tests right. What we're seeing is really on the kind of the reporting end, that contradictory information, and sometimes what we see is where a firm's review report actually doesn't really agree to the statements that were included in the broker-dealer's exemption report. So just be sure, kind of blocking and tackling on that, be sure your report lines up to what the broker-dealer is actually stating. Mike, how am I doing on time? Okay.
I'll let you know in 11 minutes.
All right. Oh, well, that's about
That's a
perfect
hint.
then. No, that's perfect then. Okay, so AT2, here's another, oh, we got a code word here, so 192.
I think you're good, though.
Okay.
Thank you.
A broker-dealer files an exemption report that includes the following statement. So this is the broker-dealer's report. It is relying on footnote 74. It limits its business activities exclusively to underwriting and M&A activity. And its third statement is that throughout the fiscal year, it did not directly or indirectly receive, hold, or otherwise owe funds, did not carry accounts of or for customers, and did not carry PAB accounts. So 3 things it did not do. It limited it to M&A activity and relying on footnote 74. Let's move ahead to our polling question. Based on the scenario, which of the following statements would be inappropriate for the auditor to include in its review report? We have reviewed management statements included in the accompanying exemption report in which the broker-dealer stated that, and which one of these would be inappropriate. Its business activities were exclusively limited to underwritings and M&A activity. It did not directly or indirectly receive, hold, or otherwise owe funds or securities to customers, carry accounts for customers, and carry PAB accounts. That sounds all about what we just read. And C, it met the identified exemption provisions without exception. Yeah?
It's a bad trend, though.
I
just
know.
saying.
Sorry.
Just saying.
I needed some emphasis, Mike. You could have highlighted.
It was a lot of
It
words.
really met the identified. So C is the correct answer. So if we go back, maybe I'll just go. Can I go back without?
Probably. Yeah.
Oh yeah, here it is. So let's look at what there was actually stated there. These are the statements they made. It was relying on footnote 74. It limits its business activities, and there are the 3 statements that it did. That it did not. So what it did not include here is a statement regarding whether it met the exemption provisions.
Sort of the finer technical point, if you will, embedded in that example is that a claim under footnote 74, if you go by the definition of identified exemption provision, footnote 74 isn't an identified exemption provision. Those refer to paragraph K of 15C33. But it's another reason a broker-dealer could rightfully claim exemption and file an exemption report. So really, if it's footnote 74 only, broker-dealer shouldn't be talking about exceptions to the identified exemption provision. Now, maybe it has other things it needs to communicate in an exemption report, but not that thing. It shouldn't be. And sometimes, seen it many times, broker-dealers just sort of throw that in, and it has no actual relevance to their operation.
I'll move on to the examination engagements. We're starting to get into a pretty narrow group of firms that actually audit broker-dealers that file examination reports. So if you look at our number of engagement reviews, 29, it's a pretty good population, but it's a pretty small segment of the overall auditors of broker-dealers that actually do this work. We had about 19, I guess we identified 19 deficiencies. They do spread out. There's a lot that goes into AT1 procedures, because specifically there's 5 FRRs, or financial responsibility rules, that factor into that, and we see deficiencies across all 5 of those. If there's any kind of common theme there, it's generally undue reliance on service organizations. So kind of what we talked about before. On revenue, it comes up again with some frequency here, but there's nothing that really is all that specific other than that particular thread that maybe has some commonality. Move on to my next scenario. Oh, here's another code word. 986. So the scenario for ICOC, that's internal controls over compliance. First fact is a broker-dealer provides all customers who consent to electronic delivery access to their account statements in electronic form. Maybe to decode that for anyone not quite familiar with this, is access your broker statement or your, I guess your broker statement or IRA or 401k electronically. You log on to the Fidelity website or wherever your service provider is and access your statement. So that's kind of what that first bullet point is, getting there. You just access it. The broker-dealer provides that access. The second bullet point, the broker-dealer generates the customer account statements using information obtained from its internal system. So creates the statement based on internally generated information and maintains the application used to store the account statements and make them available to the customers, basically the portal that we just referenced above. So they create the statement based on their internal information. They post it to their portal where customers can access it. And the third bullet point, the auditor determines controls over electronic delivery of account statements to be important to the auditor's conclusion about whether the broker-dealer maintain effective internal control over compliance with the account statement rule. All right, so 3 quick points on there, and we'll move ahead to our polling question. Mike, this is a little trickier scenario, and
Well,
am I going to be held to the same standard?
You are, though it will probably unfair to do so, but I'm going to do it anyway.
Thank you. All right.
Problem, I suspect not every single person in the room has experience with AT1, but that's okay. You'll hopefully get something out of the example. You can still make an educated guess. Good luck.
Oh.
No, you. No, they'll be fine.
Well. I have the answer here.
Well, yeah.
All right, let me get to the question. It's late in the day. Which of the following is true regarding the auditor's responsibility to test the design and operating effectiveness of controls? A, because the auditor understands that the broker-dealer's process is to make the account statements available to customers on the portal, the auditor does not need to test controls over the completeness of the population. We'll just cross that one right off. All right, I'm just going to skip past that one. B, if the broker-dealer makes the account statements available to customers on the portal, regardless of consent, the auditor does not need to test controls over customer consent to electronic delivery. That's kind of wordy, right?
It's a mouthful. Yeah.
Who wrote that?
Not sure.
The auditor only needs to test controls over the completeness and accuracy of information included in the account statement. Oh gosh, we've been hammering away on completeness and accuracy pretty much all day.
Mm-hmm.
But there is the word only in there.
The magic word is in there. Yeah.
Only.
Skeptical.
Yeah.
Skeptical of C.
The auditor should test controls. The auditor should test controls over customer ability to access their account statements via the portal.
Boy, it's a big moment here. 71, I believe. Is
Yeah, that was it.
71.
Oh!
Oh!
All right. We got
Wow. On AT1 as well.
Yeah.
That's- I'm impressed. I am impressed. Good job.
Yeah, very good. All right, I got a couple more slides here. Again, we're getting pretty specific and narrow into the regulatory findings. Net capital customer protection rule. The rates aren't unusual, maybe a slight uptick from 2022, in that the key thing here is testing completeness and accuracy of the information in those respective schedules. And then also maybe, I think that's really the key takeaway on that one. Non-compliance with PCAOB standards. I guess the one piece, and Joe, There is a little footnote there that's not explained, so.
Let me get on that.
Yeah, I think I can get
That's
to
what
that
you do
one.
when you copy and paste.
I'll highlight this one because
I know,
it
I know.
actually goes into the next one. So, auditor independence. Now, this is non-compliance with PCAOB standards. So, auditor independence, we're not actually. This isn't a finding where we believe the auditor was not independent, if I'm saying that appropriately, but rather
That's right.
there was a procedure that was not performed that's within our rules. And specifically, what this was where auditors did not obtain or did not deliver the rule 3526.
That's right.
All right, 3526 letter
Yep.
to the audit committee. And usually this is what we see, this is a finding we see with firms we're inspecting for the first time. They just may be not quite familiar with that requirement in that particular rule. So that's what that's getting at. The other findings here, they're all kind of one-offs, and I'll say the percentages are generally pretty low on that. Which takes us to my last slide that I'm going to cover. Oh, one more.
You got another slide?
I think so. At least they did.
That was the independence fund. Back up one slide. This slide explains, without expressly stating it, the footnote on the previous one. There's a distinction between deficiencies in PCAOB auditing standards related to independence, specifically communication matters. That was one category. But it's footnoted to say, hey, go over here and read about the one instance where we believe the firm was not independent. We don't want you to think that the only thing that we found was the communication matters. Granted, it's an instance of one. For those of you who've been coming to forums for a while, you know this has been a long-standing topic, and to the industry's credit, these are becoming very infrequent, which is good. We want it to stay that way. In the early years, this was a huge subject and a lot of disagreement on what auditors should or shouldn't do, but I think we've mostly got that resolved now, thankfully. So.
Yeah, Mike, that's what I was going to say.
Is that what you're going to say?
Yeah,
Okay.
exactly. Thank you.
Was that your last slide?
I think that was my last slide.
4:02. You owe me 2 minutes, but that's I can manage that. It's good. Thanks, Steve. Feel free to. Did we already hit this one? No, we didn't. That's Lucky Sevens.
Yeah, I kind of want
Lucky Sevens there. That's an easy one. Maybe that will bring me good luck. We'll see. Okay. I mentioned the spotlight earlier. Here's what it looks like. That's what the cover of it looks like. I have a few slides that are going to highlight some of the key themes from that spotlight. Actually, 8 insights. I've got one slide per insight. Spend just a moment on each. We'll move pretty quickly through these and then talk about 2024. One last reminder, feel free to interject with questions while we still have a little bit of time here. But again, this is distinct from, this is a different type of document for us. It doesn't spend time talking about what went wrong. It theorizes maybe the why. Can't know the why. We ask ourselves, why are we seeing so many deficiencies in these areas? What is it about our standards or the firms or the nature of the industry or competitive pressures? What might it be? And we all have opinions about that, and this sort of reflects the cumulative opinions of members of our inspection group who've been doing this for, the better part, well, in many cases, more than 10 years now. So, first topic, insufficient understanding of the broker-dealer industry, focusing on kind of two broad topics: financial responsibility rules broadly, and then broker-dealer operations and RevRec more specifically. So, there are times we have inspection observations that make us call into question whether the team has the right level of understanding of the rules. I think the best way to just demonstrate that is offer a few examples of what might cause us to think that. Examples could be we're inside the work papers and we're clearly dealing with a subject matter that involves one or more of the financial responsibility rules, but the papers aren't speaking to the rules. They don't mention them, they don't refer to them, they don't share the engagement team's understanding of how the rule has been applied by the broker-dealer. Or it could be in response to a question. We may ask a question along those lines. How did you consider this interpretation or this part of 3.3 or 3.1? and don't get a satisfactory answer initially, or even after the firm may take the question back and consider it further. That we can't know for sure what your level of understanding is, but that may cause us to question it. Occasionally, there are broker-dealers that we've seen that'll take the position that a certain FRR doesn't apply to them whatsoever. But it's not obvious, based on what we could see in the financials or in the work papers, why that would be the case. So we're going to ask that question. Auditor, what is your understanding of why there's no possession or control obligation for this broker-dealer? Sometimes that's not, we're met with a non-response there. So that could cause it in question. And then the distinctions between the types of exemptions that are available. What is the difference between K1, K2 single I, K2 double I? How are those the same or different than what footnote 74 makes available to broker-dealers? So that's sort of the FRR point. Those are indicators to us. On the broker-dealer's operations side, what I would say here is you got a lot of sources of information available to you beyond what the client itself might be able to provide that help you get your arms around the nature of the businesses that the broker-dealer is providing. Membership agreements, broker check, Form CRS, which is the customer relationship summary, focus reports, the broker-dealer's written supervisory procedures. All of that would be in addition to maybe process or control documentation the broker-dealer might maintain for its own purposes that could also inform you about the products and services that are being provided, which gives you a frame of reference to challenge what you're seeing in the presentation and the disclosure of revenue. And why might we challenge whether there's a sufficient understanding of RevRec? Well, the most common scenario there would be there's just an absence entirely of a mention of 606. There are complex 606 scenarios inside broker-dealers, and then there's some that are very straightforward. So, the extent of documentation needs to fit the facts and circumstances, but in most instances, we would expect to see the work papers to reflect the auditor's understanding of how 606 applies to the particular client. Okay, so that's sort of the kind of understanding or potential lack of understanding, root cause or insight or driver of deficiencies. Professional skepticism, heard about it. A lot of the speakers referenced it today. We're all experienced auditors here. We know what the concept is. We know it's important. I'll just say, look, PCAOB standard 1015, due professional care, reminds us all that auditors are required to exercise that skepticism throughout the audit. What are the things we might see that would cause us to call into question whether auditors are being skeptical? Over-reliance on inquiry without corroboration. Could apply in a wide range of scenarios, but over-reliance on inquiry. Think about your fraud risk assessment. The standards guide you to perform the required inquiries of certain individuals, and it gives you the opportunity to inquire of others within the organization that may have relevant knowledge about the risks of fraud. Are you taking the time to do that and find those others and ask those questions or not? Are you bringing the right level of skepticism to your fraud risk assessment procedures? Testing significant accounts. Here, looking to, and I've certainly seen this, where there's a clearly material account, it's quantitatively material, auditor makes a judgment, I'm not going to perform any substantive procedures on this asset. Why? Well, it's not allowable for net capital. That's the only thing that matters. Basic financial statements don't matter, despite the fact my opinion covers them, so I won't test that account. I don't think that's the right level of skepticism there. And then more blocking and tackling, errors and omissions in auditors' reports. And we have seen an uptick of this recently, and I don't know why. It could be misidentification of the financial statements that are in the filing by title. Referencing supplemental schedules, in your opinion, that don't exist in the filing. Certainly partners and EQRs should find that every single time, but I would say other members of engagement teams should be attentive to that and just do the basics to avoid those types of reporting errors. So I'm sure I'm talking to a lot of engagement executives here. You're the ones setting the tone around skepticism. Reinforce it to your teams at the right stages of the audit and establish that as an expectation that they will bring that to their work throughout the engagement. Third point here, risk assessment. We kind of characterize this as lack of rigor in risk assessment. It's kind of a hodgepodge of concepts here, but first one, hey, I know my client, I'll just default to everything is low risk without going through the mechanics of thinking about significant accounts, thinking about relevant assertions, and challenging yourself whether that view that risk is low applies equally to all of those accounts. There's a process that our standards require you to go through at the risk assessment phase of the audit. We don't always see that. High degree of, citing the fact that the broker-dealer is a technology-driven organization, and that supports the fact things are automated, they're recurring, they're repetitive, they're system-driven. Therefore, the risks are low, less opportunity for human error, things of that nature. Well, some of that could be true, but the reliance on technology can introduce its own sets of risks. And so have you thought, are you giving those equal consideration to the benefits that the use of technology may provide? And what about service organizations? If they are present and relevant to your audit strategy, to the significant accounts you're trying to audit, what effect should that have on the risk assessment conclusions that you draw? Defaulting to control risk at the maximum, I typically work with smaller firms. I do see this a lot. There's no requirement in the PCAOB standards to test controls for operating effectiveness for your audit, but you are supposed to understand them. You are supposed to understand how they're designed and whether they're implemented. That doesn't consistently occur. Again, we're not saying you have to test those, that a controls reliance audit is the best strategy. It's an available strategy, but you do need to have that baseline level of understanding. And then lack of qualitative factors when identifying significant accounts. Here, again, it's not always as simple as I have a materiality, I'll go find the financial statement line items that are in excess of that, and those are my significant accounts. There are other qualitative factors that need to be considered. Those are laid out in our standards. Some of them would include, the susceptibility of the account to error or fraud, the nature of the account and its disclosures, volume of activity, level of complexity of the transactions within the account. So, it's not quite as simple as just quantitative threshold. These are my significant accounts, and all of these are out of scope every time. So, a more thoughtful risk assessment really sets a good foundation for doing an effective audit in our view. So we encourage teams to spend the right amount of time thinking about risk assessment. Okay, fourth point, over-reliance on standardized audit programs. See this a lot in practice. Perhaps some of you are users of the service providers out there that provide toolkits and methodologies that oftentimes are inclusive of recommended or standardized audit programs, and they can be an effective tool. Don't take away from this that using them is a bad thing to do. If you take something away from this, it is at least challenge whether they should be tailored for your circumstances and your client. Why might I say that? Well, those checklists, generally in my experience, do a good job of reiterating what the standards requirement is on the specific subject matter. But it doesn't always bring into account all the considerations that our standards would suggest should be made in the area. Best example I could provide there is our audit evidence standard, which we've kind of touched on a little bit here and there today, AS 1105 paragraph 10, which is all about the relevance and reliability of evidence that you may be using in the performance of your audit. those checklists aren't going to reiterate that requirement with every single substantive procedure, but guess what? It could be a relevant consideration for every single substantive procedure, depending on what that procedure is. So, if just mechanically following that checklist, there's an opportunity to have a miss there. Sometimes the criteria don't fully reflect the requirements in the standards. They may refer you to the standards and generalize or summarize. Our standards can be are lengthy at times. So in those instances, consult the standard itself to make sure you're covered. And the third point here is they may be limited in the scope of procedures to be completed. Here I think about revenue, where I'm sure the programs will have some general thoughts. Hey, based on your risk assessment, perform substantive procedures, perform test of details if it's an area of significant risk. Well, those are good reminders, but that's not sufficient to establish the proper nature, timing, and extent of the procedures that you need to do. That would be an obvious. If it says something like perform substantive procedures, well, you need to then establish the nature, timing, and extent of what needs to be done. So again, good tool. Do see them a lot. Just a word of caution to be thoughtful about how they're used. Also, make sure they're current. That maybe our standard. You've heard the pace of standard setting in our organization is picking up. So hopefully your providers. You're staying current with them. I do think they work hard to keep their toolkits current, but make sure the version that you're using is in fact the most current available. So that's our fourth point. Excuse me. Okay, EQRs. The insight here is that EQRs are contributing to the level of deficiencies by not detecting them through the performance of their EQR review. So a few points here. Knowledge and experience specific to EQRs is kind of the first bullet, and inherent in this is I think there's a due care element that's also in play that could present itself through an EQR, perhaps not reading the financial statements, not taking the time to read the statements carefully, to do the internal consistency checks, to think about what might be omitted from the financial statement disclosures that should be present based on their understanding of the client and the audit that was performed. And that could occur, I think, if the broker-dealer has excellent knowledge, if the EQR has excellent knowledge of broker-dealers, or perhaps is less experienced in broker-dealers. You can still have a lack of due care contributing to misses on the part of the EQR. But then there are the areas that the EQR set aside. Financial statements are the second bullet here. Errors or inconsistencies in the financial statements. But the auditing itself, EQRs have responsibility to understand the audit response in significant risk areas. A lot of the findings that Steve went through, particularly in revenue, are generally situations where the engagement team has determined that there was a significant risk related to revenue, either because of the presumption that's baked into our standards or for other reasons. So, revenue is an area where we will frequently assign some responsibility to the EQR alongside the engagement team if there is a significant risk present in that area. And then auditors' reports. Same idea as the financial statements. Those easily avoidable, if I can use that phrase, errors in auditors' reports, EQRs should be finding those. They really shouldn't reach the EQR. The engagement team should prevent those from happening, but the EQR absolutely, based on our standard, is responsible for detecting those. So we'll see a lot of use of outside EQRs, which is perfectly acceptable under our standards and is the right approach, I'm sure, for many firms. But you can generate experience inside the firm within your pool of available EQRs. clearly, experience matters, but training also matters. Taking the time to study the industry, to study the rules and our standards, all those things matter, and they can make an individual be more effective in the conduct of an EQR review for any broker-dealer. So, we look at a wide range of firms with a wide range of profiles. There are options available beyond defaulting to going outside the firm, let's say, to find that qualified individual. Think about how you might be able to generate that experience on your own inside the firm as an alternative. Okay. Got a few minutes left here. Got 3 more slides. The next 3 have a lot of data. I don't know how, maybe it's readable there on the slide, but this kind of gets into sort of hours and fees and the competitive marketplace side of the equation, which we know is a very real thing. Generally speaking, the data that I'm going to share here is self-reported data by the firms. We ask the firms, you probably have experienced this, to give us a lot of data at the early stages of our inspection process. So this slide's titled Inexperience, sort of using hours as a proxy for experience. That's not perfect, I admit that, but it's one way you could look at experience. And categorizing firms into 3 very broad buckets. The darkest blue are the firms that only audit, registered firms that only audit broker-dealers. They don't touch issuers. Down to the light blue, these are the largest global firms. 100 broker-dealers, 100 issuers. The ones in the middle do both broker-dealers and issuers, but maybe don't do 100, or do not do 100. And so what's presented here is the distribution of hours over a recent period, self-reported again. It covers a 3-year period. We haven't brought this current through the 2023 inspection year. It's through 2022, but it illustrates the point. 3 years of data covers about 289 engagements, so that's a meaningful sample, I think. And all I want to highlight is really the first light blue column. So 65% of that population of engagements, based on self-reported data, were performed in fewer than 100 hours, and a very healthy percentage of those were performed in fewer than 40 hours. Again, based on firm self-reported data. Now, I'm not here to tell you that there is a minimum number of required hours necessary to audit a broker-dealer. That's not anywhere in our standards. But I do find this data interesting, and I will say I've encountered many audits that are rightfully viewed as simplistic because the broker-dealer itself is simple. Maybe it's just begun operation. Seen many broker-dealers that have 0 revenue transactions for the year based on their nature. That absolutely happens. That would simplify an audit for sure. So is it possible that 40 hours could produce a satisfactory audit? Maybe. 100 hours? Perhaps. But I see a lot of audits in those same hours categories that are more complex than I would expect to see in those buckets. And so, look, there's the takeaway here is that not every firm is going to be a global firm. I totally get that, but it is necessary to invest the time in order to comply with our standards. There is a minimum required investment for most broker dealers that will be necessary to get the work done in a standards compliance fashion. So I think with that slide and the next 2, we'll kind of paint a more complete picture, because these are all really connected concepts to me. We think about pace of auditor change as well. And again, this is data. We have enough data to kind of measure this. So this slide looks at a single year, 2022. We need to roll it forward for the next 12 months. So what is auditor tenure data telling us here? And I take away from this that roughly, if you looked at and to do some math here, you'd have to sum the bottom 3 rows. But if you did sum the bottom 3 rows, you would get to around 1/3 of broker dealers have auditors with a tenure of 3 years or fewer, relatively short. And in earlier forums, we've kind of polled as an opinion question on this. Well, an auditor change is an event that could change the risk profile of an audit, but does an auditor change, is it more likely to reduce the risk of an inappropriate opinion, or is it more likely to increase it? And there's arguments on both sides, right? Tenure brings familiarity with the client, knowledge and experience of the client. That's a good thing. Does it bring a lack of skepticism because now you're more trusting of what the client is doing? Perhaps. New auditor, fresh eyes, fresh perspective, look at things differently, perform different procedures. Maybe you detect errors that way. But you don't have the history of the client. Maybe you don't know everything. So it's an interesting debate around that. So there is no correct tenure, of course. But we do think about tenure, and we are aware there are firms out there growing their practice. Broker-dealers are moving. Sometimes it's because firms have been, through some of the enforcement actions you heard about earlier today, firms are exiting the space for various reasons. Clients are becoming available. See a lot of firms that are growing practices rapidly for various reasons. And it's important in those circumstances that maintain the rigor of your client acceptance process as you do that. We see a lot of firms that appear to be stretched from a capacity standpoint. Just number of partners, number of clients, common fiscal year ends, even with the 90-day availability for reporting deadline, that only helps so much. So, risk can be introduced into the system here through these auditor change events, and it's something that we certainly think about. Hard to pinpoint, but it may be a contributing factor. Last one here, this is where we overlay it with fees. I'll be brief because we've only got a couple of minutes left. But 2 takeaways here. One, whatever fee band you look at over that 3-year period, let's see, the dark blue is the most recent 3 years. The light blue goes back almost 10 years now. But whatever fee band you look at, the deficiency rates are arguably high. I would characterize them as high. But they do peak. They do peak close to the bottom, actually not at the very bottom, but in that 5 to 10K fee range. Not wholly inconsistent with the notion of few hours. You would expect fewer fees with fewer hours. So it's just another dimension of the same question that we're asking, and that is, are firms pricing their work in a way that affords them the ability to spend the correct hours to do a PCAOB compliant audit? I don't have a solution to the problem of potential bad actors in the marketplace. We think that there are some firms like that do exist that create competitive challenges. We don't inspect every firm every year. We can't. There's a lot of firms, 400 and something firms. That's not going to happen. But these are all dimensions that we think about as and are trying to find solutions for ourselves. Hopefully, I think this will be the last code word, 602. Let me give you 60 seconds on 602. Should be the last one, I think. I'll give you 60 seconds on 2024. The slide really does the work here. We've made our selections. We're going to look at a similar number of firms and audits compared to last year. We have increased the number of firms and audits in recent years, but this year kind of holding it flat, likely to require us to be in the field through a good bit of December. Gradually reintroducing more work at the firm location. We're still kind of pulling out of the COVID years. We have hybrid models, we have in-person models, we have fully remote models. I don't think any of those are going away anytime soon. But we are looking for opportunities to get back in the field. And yes, please, question.
So with the issuers, do you guys do yours in the same year? Do you guys take that into account?
The selections of firms and audits to review are made independently by the 2 programs. There comes a point in the process where one becomes aware of the decisions, the selections made by the other, and depending on those selections, there may be a need to begin to coordinate. And we make a good faith effort to try to do that. Sometimes we talk to firms and say, do you have a preference to do these sequentially? Would you rather put some time and space between them? You know, we can't always satisfy every firm in that regard, but the programs operate independently. So it will happen that the firm will be picked in the same year for two different purposes. Some of you probably have experienced that. But we've made our selections this year and have informed the firms and confirmed the firms. So maybe that's good news for some of you. If you haven't received a phone call, we always reserve the right to change our mind, though. But generally speaking, we're pretty late in the year, and the firms have been contacted at this point. Yes, question? I'm speaking for broker-dealer only. Thank you for asking that. I would feel bad if I misled a firm and then they got a call tomorrow. That would not be a good thing. We were able to accelerate our report by 1 month this year, which actually resets the due date. So it'll be issued by July of next year, and we're going to keep trying to chip away at that. The board's very focused on timely reporting. Hopefully, we can move that up a little bit more, but we'll see. So with that, it still says 6:30. I'm sure I'm a few seconds over. Well, 4:30. Yeah, 4:30. But thank you for your time and attention. We appreciate the questions very much.